Dear listeners, welcome to Mark's Morning Call. Real time, real markets.
Good morning, good morning. Today's podcast, would Peter Lynch invest in Marks and Spencer's? First of all, who's Peter Lynch? Very famous investor during the 90s, had a huge following for an investment philosophy that we'll touch on, but I'd like you to go and look much further and kind of find out more about it. I want to think about some of his philosophies in relation to Marks and Spencer's, because it itself is quite an interesting story, as we will investigate in a bit. The central philosophy of Peter Lynch was invest in what you know, i.e. if you can go and shop there, you can kick it, you can look at it, you can use it, then that's the start point for buying any shares and therefore kind of investing in any company. A few of the other things that I think, were certainly part of his philosophy, but I think are interesting from our perspective is stay away from companies you can't understand. So I'm guessing we all kind of understand Marks and Spencer's, and so as a result, it certainly fits that category. The other thing that I think that was all interesting was really the steps that you'd take. As we said, we start with, do we know the business? Do we have a feel for the business? The second thing is then, having built up that knowledge, having a good understanding of the industry that it sits in, and then applying your financial analysis and your valuations once you know what the story is. He also famously said, never invest in any idea you can't illustrate with a crayon. I don't know if I can do that, but I understand enough about Marks and Spencer's to have a bash at this. One of the other things that Peter Lynch was famous for, and this for me is a really important component of any investment decision, is really understanding the company management. Now, obviously, we're not in a position right now to go and visit loads of companies and talk to management, but what we can do is that we can access an awful amount and a lot of great information through investor relations websites. Now, parked on the corporate websites of all major companies in the UK is a section saying investor or investor relations, and so it's absolutely crucial for all of the companies that you're interested in is to go and take a look. I think Marks and Spencer's do this really well. So what I want you to do in conjunction with this podcast is follow my instructions about what to go look at, and then make sure that you go and have a look and then build up your own picture around where Marks and Spencer's is going. So once you get on the website, quick note, it's corporate Marks and Spencer's, not just marksandspencers.com. If you go to marksandspencers.com, then you can buy some goodies and clothes and things, but you can't find out about the financials of the company. So on corporate marksandspencers.com, then open up the investor relations, skip the ESG and modern slavery, important but not for this exercise. You'll see the annual report was issued on the 2nd of June 2025. Again, avoid that for now. A lot of information. If you're a professional analyst, then I would certainly expect you to get stuck into the real detail there, but it's a bit too time consuming and I don't think helpful in the context of what we're up to. So on the 21st of May, you can see they issued a lot of information, and the one I want you to look at is the presentation. There's also a webcast there where you can listen to management talking through the various kind of parts of the business, but it's pretty lengthy, so I think the presentation will do the trick. You'll also notice, if you wind back, that on the 12th of November of 2024, there's a capital markets event. Maybe worth just having a kind of scroll through that, particularly it was attended by lots of investors and analysts, and so as a result, you can get a feel for the kind of questions that they were asking the management of Marks and Spencer's. So why do I like it? I like it really because it's very clear in terms of what the management of Marks and Spencer's think are the critical success factors for them to take the business forward. So they're very clear in terms of the targets they've set themselves in order to make the company more successful and more profitable. What I also like about it is that it's very good in terms of this is what we said last time, this is what we've achieved. And so you can see, we know what they've set out to do, and we also then get an idea in whether they've achieved that. And the other thing is, it also is good in terms of where next. So we've done this much, this is the next steps in terms of our recovery. As an investor then, you'd be really asking yourself key questions. You'd saying, right, Have they delivered what they said they were going to deliver? Check. But also what you'd then be doing is kind of saying, do I think it's realistic that they can deliver the next stage of their plan? And so when thinking about investing in Marks and Spencer's, or any other company for that matter, that's really the question that you're asking. Track record is really important. Management who have consistently delivered what they said makes investors happy. And then the question is, can they continue to do so? Now, for Marks and Sparks, then this is a real moot point because they've had lots of stop-starts. And so in the next section, what we're going to do is just kind of have a look down memory lane and have a think about where Marks and Spencer's came from, where it went horribly wrong, and then think about the steps that they've made in order to kind of put things right going forward. So let's just kind of, as I said, take a look down memory lane. So in 2006, the Marks and Spencer's share price was 686 pence, and it's currently trading at 360 pence. And so you can see that it's taken quite a dive. In 2015, it was 546 pence and then hit a low of 99 pence before recovering to the current level at about 360. You can see that it's been a pretty turbulent ride, and although it's done well recovering from the 99p to the current level, it's still well below its peaks back in the 2000s and then the 2015. Let's take a look at that period. What did Marks and Sparks used to be? Marks and Sparks used to be where, not even my mum actually, my grandma went. So it was the kind of place where your grandpa would buy himself a nice woolen cardigan, your grandma would buy herself a nice kind of sensible skirt for Christmas or something like that. Now, the problem with old people is the older they get, the less they spend. Two reasons for that. Number one is the older you get, the more stuff you've got because you've built it up over time. And then the second thing is that you're less worried about being bang on trend, so you don't buy new fashion. So Marks and Spencer's found itself in a situation where its customer base was getting older and therefore kind of shrinking, and they didn't see any new stuff coming through. So they then went through a transformation strategy whereby they were trying to become more appealing to younger shoppers. The problem is, if you do that without really careful consideration, is the younger shoppers don't want to go there because your grandma goes there, and then all of a sudden your grandma doesn't like it because the kind of things she wants to buy are no longer available, and they're catering for a different audience. And so Marks and Spencer's found itself in a really, really difficult spot, caught between the new customer base that they wanted to attract and the old customer base who increasingly weren't there. In addition, and to a certain extent related, they also had problems because they didn't adapt to change in technology. So they had old shops that were really unfashionable. They were also kind of not appealing to younger shoppers. They also had no online presence. And so as a result, as their kind of new target customer base was moving online, they didn't really have much of a system to back up that consumer preference. So you can see that to a certain extent, investor confidence, investor skepticism around Marks and Spencer's is built upon many times where they've tried to reinvent themselves and not had great success. Anyhow, back to the past. In 2017, Marks and Spencer's appointed a guy called Archie Norman, long-term veteran, great success in the retail industry, and he started the transformation. A little bit later, they appointed Stuart Machin, also veteran, a lot of retail experience, to continue that transformation. And so when you think about it from an investment point of view now, what you're really asking is, do these guys have what it takes to do what their predecessors weren't able to achieve? And that is the big question. What I now want to move on to is just some of the metrics around Marks and Sparks, because as we've said before, it's difficult to look at particular companies in isolation, and we need to look at them in the context of the industry in which they operate and also compare them to pretty good retail as far as the UK is concerned. So if you think about Marks and Spencer's, there's two basic prongs to their business. There's the food business And then there's the kind of fashion and household clothing business to consider. So in terms of food, obviously top end, as you will have gleaned or you will glean from the website and when you go through the investor relation information, much higher margin than their competitors in terms of food. Tesco, Sainsbury's, so a 5.4% margin as compared to 3-4 that you would see at Sainsbury's and Tesco's, reflecting the higher prices that they're able to charge. On the fashion side, then they're making more like a return, as you'll see, of about 11%, which doesn't actually compare favorably with Next. And so if you look at Next as a competitor on the kind of fashion side, then the margins are kind of close to, but a little inferior to Next. Looking at the valuations, then Marks & Spencer's is trading on 12 times current earnings. It then gets more expensive into next year. Now, if you'll recall, and I'm sure you've seen that during the early summer, there was a massive cyber attack on Marks & Spencer's, which is estimated to cost about £400 million. And so as a result, even if they do a good job in terms of their operations, they're going to have a big hit to their profit as a result of the cyber attack. So if we then kind of assume that the cyber attack works through, and that we go through to the following year, then the price earnings ratio of Marks & Spencer's is 10. If we then kind of make a comparison against both the food retailers and then the fashion and household retailers, then it compares pretty favorably, assuming that they will recover fully from the cyber attack. So Tesco's, the biggest retailer in the UK, 27% market share, is on 14 times, so more expensive than Marks & Spencer's, and Sainsbury's a little less on 13 times. The big difference is, and one of the things that needs to be considered is also whether they're paying a dividend. Marks & Spencer's, because of its problems, has spent quite a lot of time, as I'm sure you read, building up its balance sheet and its cash balances, and so the dividend is quite small. Compare that with Tesco's, then they're yielding 4%. And in fact, Sainsbury's are the best yielder within the retail sector with a yield of 6%. Now, if we then flip over to Next, then, as we said, a faster growth, higher margin company than the food retailers, and Next is trading on 16 times earnings. So much, much more expensive than Marks & Spencer's. So the big question for you in terms of whether you add Marks & Spencer's to your portfolio is whether you believe the story that you read in the investor relations part of the website is compelling both against Next and against the other retailers. Good luck with that, and I'm interested to see what you will end up doing. Thank you. Speak soon.
That's all for today. Lastly, the legal note. This podcast is for informational purposes only and does not constitute financial advice. Views are our own. Do your own research and seek professional advice. Investing involves risk, and past performance is not a guarantee of future results.